Okay, let's see, we're done with the fish hook related questions, but in general, how do you set your exit targets? And you've kind of touched on that, but you might want to expand on that.
How do I set my exit targets? Well, again, we've gone ahead and there were a couple of key things you need to keep in mind. Let me get the thing cleared off here. When I'm going, this is not really an official, this is a general question, Todd? I mean, because it really doesn't
Yes,
matter.
just
Yeah, it really doesn't
exactly,
matter.
just kind of general.
Yeah, it's the same thing either way. What I advocate doing is I advocate trading. I'm looking for um, stops to go or exits at my next support resistance level, and I'm looking to go ahead and I what I've encouraged students to do is look at taking size off. So if I go ahead and we have a rally, off of the 20-period moving average, it pulls back to my support level, which also happens to be a rising 20-period moving average. If I've gone ahead and taken a trade in this area, I'm looking to hold that trade, not necessarily to here, not necessarily to here, but potentially to here, and then look at take maybe 50% off of that trade, and then see if the rest of it will run, unless I have a confluence of circumstances that are telling me, boy, there's just so much resistance here, maybe a 200-period moving average coming down, so on and so forth. If I start seeing the odds start stacking up against me that this is such a block of resistance, maybe take the whole thing off. But what the strategy is, generally try to trade to the next resistance level where you're likely to encounter resistance. Take at least 50% off. Move your stop up to break even, so that way, if it goes ahead and pulls all the way back, you've given your winner a chance to run. But if it does pull back and it comes all the way back to zero, you've made this much money on 50% of your trade. Okay, so that's something that I go ahead and try, to encourage students to get them more disciplined. I mean, you trade how you want. Obviously, you discuss it with your financial advisor. You guys determine how you want to trade. If you say, okay, I'm going to just buy the pullback here, and I'm going to get out for one tick, two ticks, three ticks, whatever it is, that's completely fine. But if you're asking what would be the best way to do it, would be try to go ahead and ride it to the next resistance level. Take 50% off or whatever percent you're comfortable with, 25%, 75%. Move your stop up to zero. That way you're all profit from that point on. If this thing turns all the way around and goes back to zero, you've still made money on whatever percent of your trade you took out. And with no risk. And if you've gone ahead then and let it run, then you see if it holds up in this area and breaks through the next level, and you let that winner run, and then you take the rest of it off at the next resistance level. So that's, at a higher level. I know we discussed it even more thoroughly yesterday, but at a high level, that's, kind of what we're looking to do. That's the beginner level concept of what we're trying to achieve here. Todd?
Okay, great. The next question is, when you have very long bars in one direction with hardly any pullback, are there any reasonable setup entry points, setups or slash entry points?
Yes. This goes ahead and, excuse me, let me clear my throat. Okay, this is actually kind of an offshoot of the question we actually had earlier. So let me go ahead and just kind of reiterate that real quick, which is if you've had these two bars in a direction, you have a couple of options. First of all, you've got my speed lines, which are going to be closer to the price action. Then you got the 20-period moving average, which will be out here. If you see enough potential after two wide range bars, if the next resistance level is way up here, and you feel that the price is going to go ahead and make it to that level, you have a couple of different options. The first option is do nothing at the close of this bar and go ahead and, because remember now, this is not the traditional two-bar setup with conservative stuff. I'm showing more advanced stuff here in these webinars than I show in YouTube and in the public channel. I don't discuss all the advanced stuff because people. I've been doing these YouTube videos for 8+ months now, and people still ask now, is that a two-bar setup or is that not a two-bar setup? So I'm certainly not going to throw all these advanced concepts out there to them, but in the context of this webinar, I'd share with you that at the close of this bar, you have three choices. Number one, you can go ahead and, well, you actually have a lot of choices. You can just dump your 6 contracts in like we talked about earlier, which is the highest risk because if it pulls back really at all, you're going to get stopped out. The next thing is you can start throwing, if you only have 6 contracts, you can throw 1 contract in here. You could throw another contract in where the speed line is. And then you could throw, let's say, 2 contracts or more in as we go ahead and rally or fall back to the rising 20-period moving average. This way, if it just after the 2 bars starts to take off on you, you've gone ahead and at least had some exposure to the market to go ahead and make some money. If it goes ahead and falls back to the speed lines, then you've gone and got 2 contracts in there, and your price basis is here. So as it blasts off, you've now got 2 contracts at this price basis and are participating that much more. If you go ahead and have 4 contracts or 6 contracts where you put 1 in here, 1 in here, and the other 4 in down, let's say here at the rising 20-period moving average, now your basis has been moved all the way down to about here, and as it bounces back off the 20-period moving average, now you've gone ahead and made a lot more money on a lot of contracts, but minimizing your risk, knowing that you had these 2 big bars. That's a huge concept, and something people should really think about. And as you look at yesterday's trade, let's go ahead and get back to candlesticks for a moment. And this is something I mentioned yesterday in yesterday's video. Just mentioned it to you guys. I don't need the line charts on this anymore because I can usually spot fish hooks just fine, kind of like I did for you guys a few minutes ago. Just you get so used to seeing what the patterns will look like, kind of like this right here. And this is the bent finger. You get a couple where it's the price action is starting to slow down a little bit. Then you get a 1-bar pullback. You can kind of start to see them and visually, mentally see them in your head. So going back to what I was saying here, so here the market goes and rallies up, and I know some people got suckered into this 1202, 1204 area yesterday. They're trying to front run the price action, and so if you do something like that, throw 1 contract in there, and if you only got 6 to play with in the first place, put 1 contract in there. Then you can go ahead and put like a second one in right here where the speed line was. So now you got 2 contracts in, and then you can go ahead and wait for the 20-period moving average, and now you got the rest of your contracts in. So you got 6 contracts in there, and then it goes ahead and holds the 1195. Excuse me. It holds the. I'm sorry. I had an audio message here. Todd, can you hear me? Okay. I had an audio message come up. I just want to make sure I'm not having a problem.
Yes.
Okay, thanks. So then it goes ahead and it rallies back or falls back to the 20-period moving average, holds the 1195, which, as you recall, was important to make sure we didn't break down below, and then it goes ahead and rallies again. So your cost basis, you had 1 in up here at the close, or let's say you bought it here when it was rallying, which you shouldn't have done, in my opinion, just because, as you guys know, that wasn't even a 1-bar break. But, just assuming you were hyper aggressive, you got 1 in there, you got 1 in here, and then you get 4 in here, and that starts to take back off. Your basis is still down in here, and you're making money. So it's a way to go ahead and scale in. If you've missed the majority of a move, but you have your speed lines coming up and your rising 20-period moving average, but you're afraid that the move is going to keep going that way, it's much higher risk. Let me make that clear. It's higher risk, and it's something, somebody who's more capitalized like me should be doing, not somebody, if you're, I've heard the horror stories. There's some people that have come to me and said, Rob, I went ahead and there's this one guy's situation that really just kind of, sticks in my head and kind of bugs me. But he lost a lot of money, and with chat rooms, which had wide stops, low profits, wide stops. He was paying $400 a month, and so by the time he came to me, he only had a few $1,000s left. I mean, barely enough to open up an account with. So obviously, I don't encourage that kind of person to trade anyways. If you lose all your money in stocks, or you lose your money in a situation like that, I don't really encourage people to then suddenly say, let's trade futures and higher margin. But the point is that if you're undercapitalized, this can if this kind of pullback can go ahead and hurt depending on how you manage your stops. Because what happens is if it were to keep going down and you don't use good money management, how far are you going to let this go down against you before you go ahead and exit? And I fear too many people have been taught over time this concept that I've heard, hey, the S&Ps are a big boys game, you got to have big stops. You know, I've heard that kind of stuff for way too long, and it concerns me. So if you don't use good stop management, then you know, getting in here, especially if you put all 6 in up here, you know, you're gonna take a lot of heat. So my recommendation is, first of all, make sure you're capitalized enough that you can go ahead and deal with pullbacks. Make sure that if you are scaling into a trade, and this is about the most important thing I can say to you, make sure you're scaling in on the right side of the trade. So if you're looking at going long, this 20-period moving average darn well better be going up if you're going to scale into this trade. Because if you're up here scaling in, this 20-period moving average is rolling over, and then as it's rolling over, you're sitting there going ahead and scaling in more and more and more. That's you're basically scaling into the wrong side of the trade. So keep that in mind, that if you get the 2 bars, or you get a big thrust in bars, but you think like we did back here, okay, but you think that the overall trend is still higher, then look at a strategy like I said. Okay, so you right here, you went ahead and put 1 contract in there. Then you put another contract in here, waiting, and then you were going to put the other 4 in here. Well, you never got the 4 in, but you got 2 in with a basis right here, and then the thing turned around, shot right back up to the resistance level, and you've gone ahead and made an opportunity. Or if you just got the 1 contract in, and you got out with that 1 contract right as it hit the next resistance level, so what? You made money. You know what I'm saying? And if you're like me and you trade a lot more than 1 contract, well, then you can go ahead and put more in. Maybe instead of 1, it's 10 or it's 20 contracts, and then you sit here, put the next 20 in here, and then you put maybe 60 or 70 or whatever down in here. It doesn't, it's the same thing. It's just relative to the size that you trade. But hopefully that shows you very clearly how you can still participate potentially in a thrust situation, but you should do so judiciously, making sure you're on the right side of the trade, making sure you know where your next your exit levels are, and where your speed lines are for adding more into the position if you so choose. Okay, Todd?
Okay, great. The last actual question for this section that we have, are these set stops that you use, or are they variable depending upon market conditions? And you might want to maybe also touch base, because I know a lot of people in this room have asked about trading stops and whatnot, and that might kind of fall into this category.
You know what, Todd? You kind of got garbled there for a moment. I heard you say, do I use set stops? And then you said I might want to do something.
Yeah, I'm sorry, let me repeat the question. The question is, are these set stops that you use, or are they variable depending on market conditions? And then I added that, in the chat rooms, I hear a lot of people asking about trailing stops, and I figured that'd be a nice place to put this.
Okay, well, we went ahead and 2 things. First of all, my stops are absolutely subjective. I go ahead and look at the risk that I'm willing to the confidence level I have in a trade. I want to go ahead and make sure that, if I have less confidence on a trade, that I keep my stops a little closer. If I have more confidence that the overall trade is likely to work, I'll work my magic with my scaling in, scaling out, and maybe let my stop be a little wider as I see the overall macro trend. For instance, some of my big shorts that I did, I went ahead and let run, as I was adding more in a little bit further and added in at higher levels than I would have normally, because all the levels were in place. The monthly chart, daily chart, weekly charts, hourly charts were all on sells. So the 15 minutes were on sells as well, but it was moving up a little bit higher. So I had the confidence to go ahead and let it run because I knew the macro trend was to the downside. So I scaled in some more at a higher resistance level, and then sure enough, it turned around and dropped like a rock. So part of its confidence level based on, here again, that's why those upper time levels are important. Are you on the right side of the overall macro trend or the wrong side? If you're going long when the overall trend is to the downside, you may want to keep your stops a little bit tighter. Excuse me. So that's one thing. So my stops are kind of subjective based on the risk. So if I heard the question correctly, there was something to the effect of, or is it based on market conditions? It is based on market conditions and my analysis conditions. Then there's some other hard and fast rules that I kind of have as well, which we talked about extensively yesterday, which was the concept of scaling into the trade. If you're scaling in and then you have a huge reversal bar back against you going against the direction of the trend, and this was actually an example then, which I showed yesterday, so we'll reshare that to further people's learning from yesterday and then show people from today. So if you're scaling into a short right here, because you see that the trend is down, so you're scaling in, I'm going to go ahead and exit that trade if all of a sudden I have a huge bar back to the upside that goes ahead and closes above my downtrending master support level, which in this case is the 20-period moving average. So even though this thing ultimately rolled back over and died, this right here tells me something fundamentally may have changed with the market. Now, in this case, just so you understand, I did not trade this. This was actually the closing bar of the day, okay? That's where this suicide bar came in here. I told you I don't trade the last bar of the day because it's just this kind of garbage here. Earnings announcements that come out right after 3 o'clock that move the futures, lighter volume, lots of market manipulation capability there. I just don't trade that bar, okay? But if this was a real bar in the middle of the real trading session that I'm trading, I would go ahead and look for exactly this kind of thing. If I've been scaling into a short, even though I'm confident because my 20-period moving average is downtrending, as soon as I get a decisive bar that closes above that moving average, that 20-period moving average, I'm going to look to exit that trade. Okay, so there's a huge stop question for how I handle like scaling type trades, in general, another stop, related method of getting out. The other thing that I'm going to look for is if I happen to be long and the market goes ahead and trades below one of my key support levels and closes below the support level, I'm going to be looking at possibly exiting as well. Especially again, if the trend changes, if I'm long and the 20-period moving average starts rolling over on me, I'm going to probably be gone from that trade. It's just there's too much risk. I like to trade on the right side of that, and I think if the more people would just trade on the right side of the 20-period moving average, more people would be profitable. That's my opinion. Todd? Oh, trailing stops. I'm sorry, trailing stops. I actually did cover that earlier with my
Okay.
with my. If you recall, what I said was, but let me just reiterate that. If I'm in a trade, I'm looking to go ahead and trade to the next resistance level. In this case, if we're looking at long, so I take my entry right here. Market's been moving up. I take an entry here. I look to the next resistance level where it is. I'm going to look to take 50% or so off the top. That's subjective to you, 25, 50, 75%, whatever you feel comfortable with, and then trail that stop, move the rest of it up to zero so that no matter what happens, you're a winner. Okay? That's a good solid trailing stop right there.
Okay, Robert, just maybe a little clarification for the students. For example, on that suicide bar that you were referring to, yeah, if obviously during normal trading hours you would use that to close that bar to get out of your trade. But so are you using a mental stop, waiting for that bar to close, or do you have like a protective, like on a huge, suicide reversal bar that just goes way above that, let's say the 1220 band there? Do you have something set up there physically, or are you using a mental stop?
Excellent question. Thank you, Todd. That's a great question. And the bottom line is I always have that mechanical stop in place because as I've mentioned yesterday, the market is going to move way faster and news announcements are going to come out and smart money is going to go ahead and have access to the information before you and I. So I always have my own stop in place at some point, and in some cases that stop, because I'm feeling more conservative on the trade, may have already been hit before the mechanical trade or before the suicide bar type situation. So to be clear, because we talked about the stops where I set my stops, I don't always use the same stops because I don't always go for the same price targets. If I'm going for 1 point profit, I'm not going to go ahead and have a 20-point stop, and if I'm going for a 20-point trade, I'm not going to go for a 1-point stop. So, it's subjective to the amount of trading that, and profit that I'm looking for is where I set my mechanical stop. But then yes, then there's the suicide stop that overrides my mechanical stop. So let's say my mechanical stop, just for example's sake, was up here. My suicide stop would kick in this place because it just violates that rule of counter trending back above. And there may be a fundamental news announcement that came out just now that I haven't heard about yet because I don't even watch CNBC. Frankly, I think I just don't watch that kind of stuff. And what happens then is the next bar then from there goes ahead and continues to rally up. Well, I'm not going to wait for that kind of devastation to happen to me in the middle of the trading day. If we have enough energy and enough power, if this was in the middle of the trading day, to get back to here, huge key reversal up, back through my falling 20-period moving average, there's likely something that really important that happened there. Now, again, this actually happened at the close from 3 to 3:15 Central Time. So this was just market manipulation, earnings, all the stuff that comes out after 3 o'clock that is very easy to do, which is why I don't trade that bar. It's just worthless to me. It's usually why you guys see me exiting the channel, saying goodnight to everybody between 2:45 and 3 o'clock, because at that point, there's just too much risk. It's too much Vegas for me. You've heard me talk about too much Vegas, and frankly, that's too much Vegas for me, especially from 3 o'clock to 3:15 Central Time, but even 2:45 to 3 o'clock is usually just too much risk for me anyways as well. So, yes, Todd, in closing on that, I do absolutely always have the mechanical stop, but the suicide stop may actually get hit before the mechanical stop. But I think everybody should always use stops, because what happens if you're short down in this area here, all of a sudden a fundamental news announcement comes out. By the time you're able to go ahead and load up your trading screens, get in front of there, do something, this whole bar could have already happened and you're down 10, 15 points. It's not worth it. What happens if you're short and they catch Osama or kill Osama bin Laden? What happens if you're long and all of a sudden a huge dirty bomb is launched somewhere in the United States, heaven forbid? What's going to happen is you're going to have a huge sell-off, and by the time you're able to exit your trade, my gosh, that thing could be down against you 20, 30 points. You absolutely need to have a mechanical stop at all times. Todd?
Okay, great. I just wanted to clarify that just in case any students had some questions, because I know you love stops and you preach it, and that's a good thing. That was the last emailed question, so people can start, loading us up with any questions they have in the under this section for setups, entries, exits, stops, that type of thing. And once we get through those, we can maybe take another just 1 or 2 minute break and then move on to the last section of the day, which is kind of a miscellaneous / market psychology category. So with that said, go ahead and start loading up some questions if you have any, and I'll wait to see some. Okay, Robert. It looks like Joe has a question. For us newbies who can only enter one contract, can you explain in more detail when to enter a 2-bar break pullback to the 20 MA? For example, at the open of the bar after the 20 MA has been touched, or breaking that bar's high. I think actually it goes down a little bit more. Let's see. High or close.
Okay. Let's go ahead and get some whiteboard here. So if you only have one contract and you have a 2-bar thrust and you get a pullback, there's 2 ways to do this. There is the buy on the close of the bar that's touching the so this is bar number 3 now. This is the pullback bar. So you have higher volume on these 2. This is assuming the perfect setup, the conservative setup trade that we've talked about. You've got higher volume on these 2 bars. then you get lighter volume on this bar. If this bar is at the rising 20 period, the more aggressive strategy of the two strategies when you get the perfect setup, quote unquote, is to go ahead and buy right at the close of this third bar. Okay, because what often happens is right away on bar number 4, the thing just shoots up. Okay, the other thing that you can go ahead and do is actually there's 2 other things you can do. If you want to be ultra conservative, what happens sometimes is the bar number 4 will trade down just slightly below like the 20 period moving average or so, and then go ahead and rally back up. What you could do is whatever the opening price of bar number 4 was, after it drops down below and comes back up, whatever that opening price was, set your buy target about a quarter point above that level, and then go ahead and get yourself into the trade there. So, because what happens is sometimes on bar number 4 there'll be a slight fake out, and then it will return back up and then shoot up. And that's great when that happens, because that actually ends up giving more energy and power to the trade, because guess what happens? All those people that get suckered into it short then add up fuel as this thing starts to rocket up, and they got to cover. So here you get in nicely down here, and the thing just starts blasting off for you. So you have there's 2 options. Number 1, close of this bar. Number 2, a quarter point above a falling. You wait to see if it falls first, then rallies back up. The third option for you to do is to go ahead and buy the high, a quarter point above the high of bar number 3. Okay, that's ultra conservative, and I don't know how often you're going to get into that trade. You'd have to put your stop basically into that trade to get stopped into the trade, basically get taken into the trade, because by the time that happens, sometimes you get so much momentum so fast in this area, it'll just blast for that. If you actually sit to wait and put your order in before that happens, you won't actually get a fill. So I would go ahead and say generally, if you've gotten the 2-bar thrust and the pullback and your volume's been met, I would say either buy right at the bottom of this bar here, the close of this bar, excuse me, or wait for a slight pullback beyond your level here and put your buy stop then a quarter point above the opening of the bar number 4, and then get taken into the trade and ride the rally that way. Todd?
Okay. Gabriel has a question here. If you were to use only one setup for all that you have, which would it be? In other words, which do you consider would be the highest probability setup?
Well, there's a couple different things with that. I mean, the highest probability setup trade that I would demonstrate with, here would be what I've shared openly for the last 8 months, because highest probability wise, if you get 2 consecutive breakout bars on higher volume, and then you get a 1-bar pullback on lighter volume, that is an extremely highly probable trade, in my opinion. In fact, we had somebody in the chat room actually back test that. Was it Gaydon, I believe it was, came into the chat room and did that, and found that it works actually quite well. So, but the thing is, what you got to understand is you're going to have way less trades then. So if if you're saying is, okay, look, I just want to trade, I don't care if it's once a week, I don't care if it's 2 or 3 times a week, I just want to go ahead and take trades that, in my opinion, if I were in that situation where I, only had 1 contract to trade, and if I lose any more money, I'm not going to be able to trade. Well, first of all, I wouldn't trade under those circumstances. I'd go, figure something else out for a while. But, I would say that if that's the kind of situation you're in, we absolutely got to think about capital preservation and risk and everything else. Again, you have to consult with your financial representative and your risk trading plan. But if you're asking me my opinion just on what I would do in that situation, where I was absolutely looking for one setup that would give me the highest probability over time, I would say that this 2-bar setup that I've been talking about for the last 8 plus months is the trade. The problem is you're going to get far less trades with that than you would implementing some of the other strategies I've shared in my like setups webinar, and that, for instance, where I gave some great alternatives to this two-bar setup, some more aggressive strategies to the two-bar setup where you can scale in and different ways to do that, and then also like my fish hooks and my bent fingers and such. So, which I think are fantastic, trading opportunities as well. But based on the way the question was worded there, I'm going to go with this two-bar conservative setup. Todd?